Jed, thank you so much for coming on the show. It's such a pleasure to have you here. We connected after I posted one of my previous interviews with another guest, and we ended up connecting on LinkedIn and ended up chatting. And from that call, it became really clear to me that I had to get you on the show to talk to us all about angel investing. So first of all, thank you for coming on.
Well, I appreciate that, Nick. Thanks for having me.
Before getting into angel investing and you imparting your wisdom and all your experience in the space, I'd love to talk a little bit about you. And I'm wondering if you can share with us a bit about your background before you got into angel investing.
Yeah, absolutely. So I found my superpower after doing grad school, after doing my MBA, which I think just really is a way of saying I've paid way too much for an education. I realized that my superpower is in the 0 to 1 of building new tech businesses. Essentially, I think I thrive in chaos, right? Because there is no rule set, and you can make mistakes all day long, fluff up, and still come out ahead, right? And you've got the opportunity to write the rule book, which is what I find particularly interesting. So I started a string of tech businesses, the last one being an API marketplace. The interesting thing about this particular venture was I did it in partnership with a startup in San Francisco that went from 5 people in a WeWork to raising capital from Andreessen Horowitz to building the world's largest API marketplace together. And today they're a unicorn. So we sure picked right.
You sure did.
And I think around that time I was working with all of these startups and I just got bit by the bug. And so I decided to take a swing on angel investing. I took a chunk of capital from my own pool and put it aside and said, I'm going to go look for some startups and put this at risk and see how we go. Right. So I've never had any professional training, never worked in VC officially. And I just decided to take a swing of it, which really is more common than you would think. Those early bets ended up going okay, Nick, because I got my first exit in my second year. I invested in another company called Turing.com in 2018. They've turned into a unicorn, and so however you count it, I might have done seed to unicorn twice, right? So let's agree that there's some data points that suggest I'm not completely terrible at angel investing. There were these early data points that suggest that I wasn't terrible at angel investing. So the question is, okay, what do I do next? The classic path in front of most angels at this point is to go down the syndicate route or to start a VC fund. Right? For whatever reason, I didn't think I was quite ready for a fund. So I started down building my own syndicate, and it's gone remarkably well, far beyond what I expected when I first started, when honestly I was just prodding around in the dark. So where I am now is that I've built an investor network from 0 to over 1,000 investors, or LPs as we call them. We've done all of this organically, and it's been a fantastic way for us to scale capital. I've basically gone from writing 10 to 20K individual angel checks to writing 6-figure checks. And it was this crazy side hustle for a couple of years where, I was literally writing a $250,000 check on the weekend as a hobby type of thing. So I jokingly refer to angel investing as my multi-million-dollar side hustle.
It's this is exactly why I wanted to have you on the show. This wealth of experience and the successes that you've had to date really stand out, and I'm delighted to have you here. I'm intrigued for a moment about what you've done has been really impressive. I'm wondering where you see the angel investment or investing industry going over the next maybe 3 to 5 years.
Yeah. So I have a core thesis about where the world is going. That thesis is that capital availability is not the problem in venture. Right? There's plenty of capital. Despite what is going on in the world today, governments have been printing money for over 10 years. Right? Why that capital is not being deployed today is basically because of risks, not because of the availability of capital. At the same time, there is clearly an appetite for private market investing. If you look at some of the data points out there, look at equity crowdfunding platforms. right? Or in the initial days, there were these platforms like Indiegogo, right, that were funding these consumer projects. Today, you have platforms like Republic that put startups there and investors can deploy capital. If you look at, let's say, um, crypto projects and ICO, however you feel about it, I'm not advocating for them one way or another. I think all of these things signal an appetite for private market investing, right? So my view over the next 3 to 5 years is that, this pool of available capital is going to keep growing. And whoever can make the market and move that capital to efficient use can seize the opportunity.
That's a really interesting take. I'm wondering as well, is it that do you see that more maybe successful entrepreneurs or startup operators themselves are looking to move into angel investment as a asset class to differentiate or diversify their portfolio, or is it something else that you're seeing this growth in private capital?
Yeah, I certainly there's a let's call it a prestige, right, or a cachet today with being a founder, whether right or wrong, right? I to be completely transparent, I think hyping up the world of startups and how absolutely difficult and brutal and grinding it can be is in some ways a disservice to the people who are considering this as career choices, right, or life choices. Um, on the other hand, I also think that there are individuals that want to be startup founders, but really don't quite have what it takes, right? And I think there needs to be a reckoning and to be honest about with the ecosystem, right? That hey, this world is hard. If you're going to do this, you need to be prepared for it, right? And I think also for founders to get in for the right reasons, right? You have a high burden of responsibility when you decide to do this, right? If you're accepting investors' capital, you are a custodian of their capital. You have a responsibility, and these things come with it a heavy burden. A 20-something. It takes a long time to build the CEO skill set, right? And somebody who's kind of coming out of college with all the energy and chutzpah in the world, they aren't necessarily quite equipped for that. It does take time to build, and maybe they don't understand all the things that come with it. But to your question, I do believe that the people who are innately founders and innately investors, early stage investors, they are two sides of the same persona, right? What draws operators into the investor world is, I think, more about giving back to the community, not just in terms of capital, but also their learnings, right? And to help others be successful because, like we described, it's bloody hard.
Yeah. Yeah. I think that brings us nicely onto my next question, which is about the nuts and bolts of raising angel investment. And one of the questions which I think a lot of founders ask themselves in the early days when they are considering raising capital for their business is, I've got a couple of different options, and the two biggest options out there are raising angel investment or going directly to venture capitalists. Can you talk to us a little bit about why a founder might choose to go down the angel route as opposed to going down the VC route, and when either are more appropriate?
Yeah, I think the general broad rule is when you're starting out, or when a founder is fundraising for a company, the way you approach it is to take as much capital as you need to get to the next stage of your business. You want to take the minimum amount of money with the highest possible valuation in order to give up as little as possible of your company. Right. So the amount that you raise essentially is going to be a function of the stage of the capital. And whether you go towards angels or VCs, really, it's a function of that maturity. right? So when you're starting out, it's a lot of friends and family capital, right? You hustle hard enough, you could probably put together, 6 figures of capital in order to build a product, and launch something in market, right? Then you want to take the company to the next stage and to show traction on your go-to-market and growth. This is when you approach, external angels, or potentially syndicates, to get you to a certain level of traction, and then that's really when VC funding tends to come into play, right? For what VCs do, they've got a certain pool of capital that they've got to deploy from, right? So they need investments that are mature enough to soak up, to take in enough capital, right? It's too much work to be, writing, let's say, like 50K checks or sub 100K checks, for the most part.
Do you ever recommend for founders to look to raise from both groups simultaneously, or is there additional challenges with that?
Yeah, I think it tends, you can't build a two-pillared strategy. I mean, how they could fit in is if you're in a position to do a VC round, you've got a lead investor who will take a good chunk of the round, not necessarily the largest, but that term sheet might come with strings attached, right? They might say, hey, you need to hit a minimum raise of 2 or 3 million, right? We'll give you half of it, but you got to find the rest. Otherwise, the deal doesn't go through. So that's potentially a scenario where founders could fill up the rest of the round using angel checks.
That makes me think a little bit about something else which has been on my mind with respect to raising angel investment. And that's around the people who a founder should go to. I'm wondering if you might be able to give some advice to founders when it comes to raising angel investment. Should they be looking to raise from an individual angel, or should they instead be looking to raise from a syndicate of angel investors? And what maybe are the pros and cons that exist for either of those options?
Yeah, absolutely. So when a founder is out fundraising, right, essentially one of the hardest bits of this for first-time founders, or, you don't have that Rolodex of people who are going to back you, is the absence of networks, right? The people that you're going to go to are people that who already deploy capital, and, if you don't come from this world, chances are there aren't that many. Right. So the question is, okay, who do you go to when there is enough sufficient capital there? I think this is exactly where angel syndicates excel, right? The common trope that you hear from most founders, okay, why work with a syndicate? And they'll say, well, it's a larger check and there's a single line on the cap table. And those things are true, but they're just the byproducts of the value that you're getting from a syndicate, right? So what do I mean by this? Underneath the ability of a syndicate to bring you a 6-figure check, what's driving that is a lot of pre-built relationships and inherent trust in that network that takes months and years to build, right? It's not a mailing list, it's a Rolodex of relationships, right? I don't know, maybe some of the founders listening to this are too young to know what a Rolodex is, but
they can Google it.
Yeah, exactly. Yeah, but it's those relationships that we bring, right? And the ability at those relationships is what allows us to compel capital. I think working with a syndicate, you're going to be subject to a higher burden of diligence compared to working with individual angels. But again, the prize here is that, you're playing for a 6-figure check, right? For where we're at, writing 100 or 200K check is, I'd say like relatively trivial at this stage.
When a founder is looking to raise from a syndicate, in this case, what should they expect? Should they expect to be dealing with one person? Should they be expecting to pitch to a whole group of a investment committee? How does that typically work for founders?
Yeah, I'd say it depends, right? There's with syndicates, there are groups that just are extremely loose in terms of the organization, the relationships and governance, and others that are maybe a bit more established or mature, or they've got a more rigorous investment process that resembles what they might be put through with a VC firm, right? So it really does depend. I think regardless of how you approach it, it's always a good idea for founders to be fundraising ready before you start, right? So what does that mean? Well, one, you need to put together a data room, right? Do you know what goes in there, what investors are looking for, right? The more you get that stuff ahead of time and have it organized, it makes your life easier when you're going out to do this. The other thing, and it's probably something we'll get to a little bit later today, is how do you approach investors, especially if you don't know them in the first place? How do you get somebody's attention, right? It's an interesting challenge because, going back to that situation where you're trying to raise capital, you don't have a whole bunch of investors in your network. How do you get somebody's attention if it's cold, right? It's a hard thing, right? And that in itself is another skill set to learn.
We've talked about some of the differences between raising angel investment, venture capital. We talked about some of the complexities of doing so. I'm wondering if you can give the audience maybe your top tips for a founder who's listening to this, watching this right now, and they're looking to raise from either an angel or a syndicate. What are your top tips for one of those founders who's looking to raise now?
Sure. My view, and this might be just an opinion, right? I think certainly there are different people who have different takes on the subject. One, get your pitch deck together. That one's fairly obvious and commonplace. But it's not just like the pitch deck, right? A lot of pitch decks can give away negative signals that the founders themselves don't even realize. So it's a good idea to just put that in front of other investors and get feedback on it, right? There are times where a company looks interesting at the surface, but looking at a pitch deck, I can pick out a few hairs on the deal that I don't like that make it a non-starter, right? But you can get ahead of that if you get the right feedback mechanisms. The second thing I've just spoken towards was get your data room ready, right? Besides your pitch deck, what do you need? Well, you need employment agreements. You need incorporation agreements for your company. You need IP assignment to say like whatever work is done in this company is owned by the company and not by a founder or some other key employee. You need to get your cap table ready. If you've received investment in the past, get all of that organized and sorted so that it's ready when somebody wants to dive in. It looks organized, right? And that moves the chances on getting you towards a deal. I would also say, do your research on investors, right? Be bespoke and personalized and purposeful about who you reach out to. Because the worst thing to get is, assume every investor has an ego, right? That's probably pretty safe to say. It's just about a truism. And it just doesn't work for you to have a generic, non-personalized, mass, cold message, right? It just will not work. It's efficient for you because it seems like you can reach out to 1,000 people, in a matter of 10 minutes, but they're just about all going to fail. And the biggest one, I think, for people who are listening to this is my number one top tip for what you should absolutely pay attention to when you're out fundraising. You need to write copy for your company around how you introduce your company extremely well. Like, I can't tell you how common it is that I get a cold inbound or a message or an outreach from a company who's trying to fundraise. And I'm trying to give it a time of day because I know it's hard. I've been there. And I read your message and I still don't understand what your company does. For me, that's a non-starter, right? Then everything that you've done down the line, the pitch deck, your data room, all of that is inconsequential, right? You have that, it's like a job interview, right? Unfortunately, You have about 15 seconds to make that right impression and draw an investor into a conversation. That first outreach, you get so little of time and energy just because, most people are just bombarded. They're busy. I'll spend seconds or less than a minute on that first message. And if it doesn't catch my eye, don't understand it, like, you're done, right? It won't go any further. And if you think about it, it's something that's fully within your control, right? Write down 4 lines explaining to me what your company does and why it's particularly interesting. Keep it simple, and just that's your hook, right? Make it dead easy for me to understand, right? Or whoever you're reaching out to. So that's my top tip.
I think they're fantastic tips. And I remember some time ago, I was on a pre-accelerator program and they spent an entire day, actually, entire session effectively, talking just about nailing down your elevator pitch and the importance of that. If you don't get your elevator pitch right, or even in written form, you've basically shot yourself in the foot. Everything else after that won't matter because an investor won't really care because you haven't nailed that first part down.
Yeah, there's something about the psychology there, right? When it's your company, it's your idea, you're very emotionally invested, right? So it's easy for us to sit here and say that, wow, that's obvious, but the what's involved, in this whole process is a lot harder to disassociate yourself, right? And
100%.
Step out of it, right? Just you're approaching somebody for the first time. What do you say? Like, how do you get them hooked?
I want to go back to the first tip that you gave with respect to obvious mistakes that founders make when it comes to their pitch decks. And for those founders who are listening to this right now and maybe are putting their pitch decks together or they've already got one done and they are now hearing this and they're saying to themselves, what are those things that that founders get wrong? What are kind of the top things that you kind of see in those pitch decks that you say, oh no, not again? We should be past this by now.
Yeah. So explaining the idea, making sure that the idea that whatever you're doing, that it's understandable, firstly. The second thing is make sure it's differentiated, right? Be sure to communicate why what you're doing, why the approach is different, and why you think it will win. Right. Things that I'm particularly sensitive to. One of them is equity crowdfunding, whether fairly or not, right? This is might be a controversial point, but for me, equity crowdfunding almost always is like a non-starter, right? I'm looking for reasonable asks on your fundraising, especially when it comes to the terms. So I'll give an example. There was a travel tech company that came across my desk, which ordinarily isn't a space that I would invest in, but I took a look at it, because somebody in my network said, hey, would you give me an opinion on this? The thing that really put me off on the deck was that they had no clear business model on a consumer business, which is always like scary. And they were looking to raise $5 million on a pre-seed round. And on the use of funds, the biggest line item they were spending on, 36%, was on marketing. Right? So let's unpack that a little bit. In terms of order of magnitude, the amount that you're trying to raise is completely out of bounds with even the best of markets, right? If you're aiming for a $5 million raise, and you need to be aiming for at least a $20 million valuation, right, on a pre-seed company, which is crazy, especially given the metrics and the traction that we saw. And if there's no business model and your single biggest line item is on marketing, it basically makes me think that you are fast and frivolous with capital, right? And you can only grow if you have a pool of capital to deploy from, right? To burn, right? Otherwise, you can't make this thing grow, right? And at the earliest stages, I don't fundamentally believe that, a performance marketing go-to-market with no monetization and business model on the other side of it, is a recipe for success, right?
So, Jed, that brings me on to another question, which is about valuations and pre-money valuations. So, for founders who are listening to this and they want to initiate that conversation with an angel or with an angel syndicate, how should they think about their pre-money valuation? What model or approach should they use in your recommendation and experience?
Yeah, so there are these convertible instruments and safes that are quite common in the US, and relatively well known in Europe, I would imagine, that honestly are such a godsend for founders, right? They help you get around this explicit valuation question at the earliest stages of the company, right? Not entirely. I mean, these instruments have a valuation cap, which sort of anchors the value of the company, but they help you get around it, right? But the cap still exists. I think the way I would think about it is like if you're out fundraising for the first time, what you can accept for valuation is going to be a lot driven by the constraints of your local ecosystem, right? Like that early stage money is going to be super local and people looking around you. They'll have a certain set of expectations that could be very different from somebody in another continent, another part of the world, even in another country, right? So I think that the baseline starting point is, okay, what is common in the kind of companies that are in your sector, in your local ecosystem? That's the kind of the way I look at it. And from there, you can move those numbers up and down, those valuation numbers, depending on any variety of factors, right? One is, okay, well, what is the market climate like? Or is there certain traction that you can show that differentiates you from other companies? If you are a repeat founder, you might have a bit more credibility, the ability to command a higher valuation, effectively de-risking the company. So that's kind of the way I think about it. And as you grow into like the later stages, when you get towards institutional rounds, the VC firms will, probably tell you what valuation they're willing to offer you, right? And that becomes the starting point for negotiation.
Speaking of evaluations and rounds, have you ever had the experience of joining in a down round, or how do you feel about down rounds?
Yeah. I suppose if I was in the company already and faced with a down run, I wouldn't feel particularly great about it. But a company that is fundraising on a down round, we'll take a look at it. There could be reasons to still get involved, but obviously in that scenario, you lose a lot of the bargaining leverage, right? There could be extraordinary terms or things that are expected from new investors, right? If it's a down round and for example, your liquidity constraint, that's, not a great recipe, right? You're going to take a big haircut.
We've been talking about these different rounds. We've been talking about how to go about raising angel investment. When it comes down to the nuts and bolts then of the documentation that's going to be sent over to a founder and they've got it in their hands, and now it's time to, get a legal eye over the terms. What are some of the terms that a founder can expect that a angel will typically have in their terms, and which maybe are different from what a VC might include in theirs?
Yeah. I think with working with angels or even syndicates, they're relatively straightforward, right? So get comfortable with convertibles and safes, right? Those will be pretty standard. Now, when it comes to the VC type negotiations, right? We can put the considerations into two big buckets. One is, well, the valuation and how much of the company that you're giving up for this particular round. The other bucket of things that you want to look at are basically the control clauses. Right. What are the things in that document that gives the VC investor control or that lets them dictate terms on your company? Right. So these can be things like liquidation preferences, which basically means that they recover their initial capital after creditors, of course, but ahead of other equity investors. Right. They're basically moving to the front of the line in terms of cash flow. They could be things like ratchets is another one to pay attention to. Ratchets basically happen when if a company is having a future fundraising that is a down round, like you just described, Nick, and it basically says that, hey, you're not allowed to dilute us, right? Or not allowed to dilute our investment. So if that happens, you've got to award the VC additional shares to make them whole, right? So that their share in the company stays at a certain rate, right? And depending on how that ratchet is structured, it can be more or less aggressive.
Institutional investors are typically going to want to have a board seat or two for themselves. What do you typically see with respect to angel investors and angel syndicates when it comes to board seats?
Yeah, I'd say the board seats representation and control ultimately becomes a function of how much capital you bring, right? Or relative to the time that you invested. Angels, unless they're highly strategic to the company and they can be an advisor, they're not typically represented on the board. I think in general, if you're investing, say, over $1 million or more at a seed or A round, you might be entitled to board observer seats, but no guarantee of board seats, right? It's only VCs when they invest, they've got a mandate to have a certain stake in the company, and that's the time when board control and representation kind of comes into play.
Jed, we've been talking a lot about valuations and the sort of more monetary side of angel investing, but there's a whole other aspect to it which I have picked up and from my experience and also from your experience as well, what you've been saying on this call, and that's that kind of soft side, which is the non-monetary investment that comes along with angel investing. And I'm wondering if you might be able to talk to us a little bit about what a founder can or should expect from an angel investor when it comes to the non-monetary side, as in how can they draw upon their experience or that of the wider syndicate that's investing in them?
Yeah. So when we first started deploying capital through our syndicate, a lot of the conversations were being drawn to, hey, what's your average check? Right? Because for the founders, they're effectively vetting us, right? They say, well, how much capital can these guys swing? And that dictates how valuable we are to them. And it helps them decide how much to invest in going after that capital. The way we fundraise now is that, I do talk about the sort of investment quantums that we invest in, which are a lot higher. But what I've noticed that really gets the founder's attention is to say, like, hey, I've built a syndicate. I have a relationship with every single one of my LPs, and I'm backed by over 1,000 of them, and they're all over the world. And that's the one that kind of gets them lit up about it, or gets excited, right? We start thinking about, just earlier today, I was on a diligence call with an ed tech company that's growing like bonkers right now. And, the founder made a comment to me that, oh, yeah, we like angels because they want to get involved more, they help, right? And so through a syndicate model, if you've got access to 1,000 LPs, and if we do a deal and maybe like 40 or 50 of them come on board, right? And that becomes an extension of our network. And I think the question becomes, how can founders best take advantage or tap into that? I think here what founders should be doing is don't go out and put people into your investors or advisors in the boxes, right? I need help with A, B, and C, and I'm looking to fill those boxes, because the nature of what you're building, it's a long-lived relationship. Those needs change over time, and you're going to find things that you haven't ever expected. So what's really helpful is to be communicative with your investors, right? To be able to share with them and let them know that here's how we're doing, and let people feel involved in that journey, and be clear about what you need help with, right? Because then when you're communicating out to investors with regular updates, and there's a standard section there that says, hey, here's where we need help, right? People want to root for you. They want to get involved, and so it's a simple thing, but it's really about being communicative and articulating what you need help in, and to give others a chance to step up and to be part of that journey and help you be successful, because honestly, we're all rooting for you.
Yeah, and your money's on the line as well.
Absolutely.
What format should that communication take? Because I've seen different examples of founder to investor communications, and I always kind of feel as well that one sign that a company might not be doing so well is that the communications start to trail off, and you start to get a little bit less and less. What do you recommend to founders for communicating and staying up to date with or keeping their investors up to date with what they're doing?
Yeah. What works best for us is, send out a monthly or no less than a quarterly update. Have a standard template so that it's efficient for you. It's just standard things that you update on a weekly basis. That makes it super efficient for you. You want to be metrics driven and to show the numbers and the growth, and to be extremely transparent of that. And to your point, when things are not going well, this is the journey, right? Nobody gets into this expecting smooth sailing. So it's expected, right? And while that inclination to pull back and to share less when things are going wrong is probably the opposite thing that you should be doing. Because people will sense that it just sticks out like a sore thumb. And then people get nervous, and then they go to start ratcheting up the pressure on you, right? Which is exactly what you don't need in when you're under duress.
Yeah, people breathing down your neck. When it comes to finding angel investors, what's the best way of reaching out to them?
Yeah. So think of the investor's perspective. Every investor has an investment thesis, right? It's going to be a Venn diagram of three things, if you can imagine in your head. One is the sector. What sector does a person invest in or would be interested in? What stage are they going to be investing in? And what's the geo that they're interested in? Okay, so there's these three bubbles, and they kind of overlap. I have something I call the 70-20-10 rule, right? If you think about 100 points and breaking it up into these three buckets, 70% of what drives a person's interest, an investor's interest, is going to be the sector, right? People need to understand something to get excited about it. Like, could you ever get jazzed up about something you have like absolutely no affinity or understanding to, right? It's just not a very intuitive thing. The second thing is going to be geo. So 20% is going to be what's driven, it's going to be driven by the geo, like what markets do they focus in? Again, very simple. Early stage, it's local to you. And the last one, the last 10% is going to be the stage they invest in. That one primarily is a function of how much capital they invest, right? A 10K or 20K check, you can play at pre-seed, seed, maybe wiggle it in an A round if you're doing a follow-on, right? That's about it. So take these three things in totality. Okay, how do you prioritize if you have to go out down the route of cold outreach? There's this great tool going out there. It's just like all the buzz. It's called LinkedIn. I don't know if you heard of it.
No.
I've never heard of it. If you go to some of these LinkedIn profile, right, their professional bio basically gives you the exact answer for that 70% question, which is, what do they know and what might they be interested in, right? It's really simple. And on the top of their LinkedIn page, it says what country they're in or city, and maybe the where they've worked in the past, right? They could have been in different places. So those two things in totality, they solve you 90% of your question, or they give you a 90% guess on when you're reaching out to somebody cold and trying to target, right? So it's not rocket science. And if you go through this, I think the odds of success, making a successful first contact, they'll go up tremendously, right? Rather than sending 1,000 messages to like a random people.
Yeah. Yeah. As an angel investor, what are the top 2 or 3 red flags that you kind of come across frequently enough and you say, these are things which once I see them, I'm like, no, I'm out. I think you've actually covered one of them earlier on with respect to equity crowdfunding. But I'd be interested if there are any more. And actually, if you're willing to, maybe if you could talk a little bit about why equity crowdfunding for you is such a no-go.
Sure. So the cardinal sins, we might be rehashing a little bit, but besides the equity crowdfunding, and that's like that's an opinion that's very much me, right? I don't think it's all that commonly held. Maybe it's a 50-50 thing. But when a founder is reaching out to me and I don't understand what they do, right? That one is like a big thing. You basically, your job is to sell the company, right? Or is to sell customers. In this case, you fail to. You can't even communicate your own company or product. It's a very big red flag for me. The other one, in my view, is when founders are trying to fundraise on pure vaporware or slideware. Right? To caveat all why I'm saying this, I invest mainly in software. I like investing in software because I think software is cheaper to scale, right? There are a bunch of new servers or cloud infrastructure, and you can grow and you can keep growing like that. It's not like hardware, which is called hardware because it's bloody hard. So as a software investor, for somebody to come and fundraise without the ability to have built something and put something into this already, it's a bit of a deal breaker, right? It either means you're too lazy to put in the work, or you don't have the technical chops to do it, right? Either which I think are glaring holes. So let's go back to the other point about equity crowdfunding. What is the issue there? By and large, the business model of equity crowdfunding platforms is to take a slice of every dollar of capital that they move through the platform. Right? They generally do not play for a slice of the upside. They generally do not take equity in the company, or if they do, it's skewed highly towards the upfront fees, typically 10% of the raise, and then a tiny portion might come out of the equity in the startup. So my issue there is that it skews the incentives of the platform to focus on making the market with diversity of deals, volume of deals, to show a flavor for every person who's on there to try and move capital. And it goes against, there's a fundamental tension with that approach and having the best quality companies or investing time to do diligence to curate that, right? It's a very hard balance to thread. I know some of them do for better or worse degrees, but it's a fundamental tension that I think it's very hard to get rid of. Another issue with equity crowdfunding is that if you look at the average check sizes, they're very small. We're talking about hundreds of dollars, maybe up to like $1,000 would be a big ticket. Essentially, we're talking about throwaway money for most investors, which means that the people backing the company, by and large, haven't invested enough to diligence the company. So the amount that the company raised is not indicative of the quality of it, right? Simply because of the smallest check sizes. Yeah, and so these, and I think the third point is that a company that is fundraising on equity crowdfunding, it's in contradiction to what I do as a syndicate, right? This is like a matter of like different incentives, right? For me, I run the deal. I put a lot of work into the diligence. I have a minimum check into it, which is going to be a lot higher than an equity crowdfunding platform that takes a percentage of the initial capital, but 0% carry. Whereas we're just about the opposite, right? So I don't particularly like having, it seems a bit in conflict to participate in a fundraising where somebody might go, well, okay, I could invest there, right? I'm not paying 20% carry. It diminishes like the work I do, right? Yeah, so these are the three buckets. I guess the first two are more fundamental, critical things in my view. The third one just happens to be, this in a way competition, right, between the source of capital on the crowdfunding platform versus like my syndicate.
I have a final question with respect specifically to angel investing, and it's about that sort of deal flow side of things. I see from time to time people who are effectively representing startups and are saying, I will work with you, founder, to find investors for you, and then I will take a cut of the action. They're not investing themselves, typically, from what I'm
They're
seeing.
brokers.
They're brokers. What is your perspective on brokers?
Yeah. I think the dynamics come down to the same pressure points as equity crowdfunding, right? I'm not saying brokers or equity crowdfunding platforms don't have value in this ecosystem, but from the perspective of an investor into the company, if somebody is bringing the deal to me and their incentive is a share of capital, it's like the investment banking business. Yeah, they're trying to make a deal, and after that deal, they've basically cashed out. They've got zero alignment or incentives to work with you for the long term. Well, until they've got another deal and they think you're a source of capital, right? So, I wouldn't say that we would categorically never do a deal like this, but I generally, am adverse to it, I'd say.
Understood. I think this conversation has been really informative, and I'm absolutely positive so many people are going to be trolling through this and making notes and coming back. This has been fantastic, Jed. I'm wondering though, is there anything that I haven't asked you about angel investing, which you think, something needs to be really mentioned to founders, or a last parting piece of advice for founders who are looking to raise angel investment?
Yeah. So I think for founders, if you are looking to raise capital, like do think about the syndicate option, right? People who do run syndicates like myself, and I'm not plugging my own, there are lots of people that do this. What you're getting are, dozens or hundreds or thousands of pre-built relationships, and they have the ability to move that capital for you. There is an exchange. They're going to have a high degree of diligence and work. They're going to put you through, ask more questions, and you need to be prepared to do that, right? But if you can do that, I think there's something magical that happens when we decide to back a company. Suddenly our incentives change and we are really maximally aligned with the founders, because now we love this company, we've decided, and we want to back them to the maximum degree. So we like really lean into the fundraise to make the deal happen, right? But yeah, and it can be a really, I think, healthy and symbiotic relationship, right? So maybe I'm biased because I'm running a syndicate, but I think they're certainly worth considering, if you're trying to pull together a $250,000 check rather than, hustling around for 55Ks or something.
As we're approaching the end of our conversation together, I'd like to just touch upon exactly what you've been talking about there with respect to your syndicate, and also maybe if you could talk to us just a little bit about Angel School as well.
Yeah. Is it okay if I put something on screen, Nick?
I'd love that.
So I guess in conclusion, Nick, I'll just talk quickly about what we do at Angel School. If anybody's interested, our website is AngelSchool.vc. I've developed a program where we help angel investors become super angels. So what does that mean? We're going to help you do that by building and running your syndicate. So I teach an 8-week playbook program where we help angels learn all the fundamentals around leveling up their skills as an angel investor and then building a syndicate to bring capital to bear with it. And after this 8-week program, I invite all the angels to come sit on my investment committee. So this becomes a forum where they can work on real deal flow, build their investor networks alongside me before they go off and do it for themselves. And so if anybody sees this and they're interested to learn more or chat about it, I'm more than happy to. I'd love to connect.
This is amazing. It's a really interesting program that you run. I've been doing my own research into it as well. It's very exciting. For people who are interested, you're saying this is for angels, effectively to become super angels. What if somebody's watching this and they're saying, oh, I'd like to join this, but would I qualify? What are sort of the criteria that you typically look for somebody to join?
Yeah. So there's a few ways to get involved, right? One is that if you're starting out in angel investing and you just want to see great deal flow, you can go to our website, go to the For Investors tab, and apply to invest, and we'll have a chat and I'll share my deal flow with you. There's no strings attached. You can invest in every single deal, nothing, or somewhere in between. And you get access to all my diligence on all my deals, right? So it's a great way to learn. Now, if you've done some angel investing and you think you really want to get serious about this and level up, this is where the fellowship program is, it matters, right? This is the part where we take you and go from 1 to 10. What we recommend to the investors who are interested in this is you need some basic angel experience, because I won't cover the basics, right? This is purely about taking you to the next level. We go super fast. It's pretty intense. So first thing we look for is basic angel experience. The best proxy or the best indicator is you've invested in maybe 2 or 3 companies of your own. So we know at that point you've got capital, you've got the risk appetite, and you've probably read a few term sheets and convertible notes and understand the basics. The other thing that I screen for is, does this help you get to where you want to be, right? Does this help you get to the next level, and how much do you want to do this? Because effectively, I've taken 6 years of angel investing experience, 6 or 7 years, 3 years of syndicate building experience, and compress that into 8 weeks. I can tell you what to do, and more importantly, what not to do. I will help you enforce 20% carried interest from day one, from your minimum check to a 6-figure investor. No issues there. But I can't help you if you won't put in the work. So people need to be prepared for that, right? So we basically laid the trail, but you still got to walk the miles.
Wow, it's a really exciting program, and I'm sure people watching this who have any interest in angel investing are looking at this with a lot of desire to become part of one of your cohorts. So yes, I strongly recommend anybody who's watching this who's interested to go to the site and look to apply. Jed, thank you so much for all of this, for joining me on the call today, and for imparting so much experience and so much wisdom around angel investing to the audience. I know, as I said earlier on, for sure, people are going to be sitting down, taking notes, going back and bookmarking parts of this episode, because there's just so much there, especially for those people out there who are looking at raising angel investment for themselves in the short or medium term. So yeah, I'd just like to say thank you so much for coming on And I really hope that we can do another show in the future, maybe focusing a little bit more on the investor side down the line when that time comes.
Yeah, I'd love that, Nick. I appreciate you having me as well. Thank you.